The 1st of July 2026 has come and gone, and that single date has already changed working life for almost every Australian, whether you're an employee, a business owner, or simply someone with money sitting in super. Some of these changes are small, others are significant, and one of them is about to make your next tax return a lot simpler. If you haven't caught up on all of this yet, this video will bring you up to speed. Let's go through it one by one. Quick note before we start. I'm not a financial advisor. This is general information, so always check with a registered tax agent or advisor for your own situation. Let's start with something you may already know about. The 16% tax bracket has dropped to 15% for anyone earning between $18,201 and $45,000. That puts up to $268 extra in the pocket of anyone earning more than $45,000 this year. We covered this in detail in an earlier video, so today we're moving straight into the changes that barely anyone is talking about. And honestly, some of them matter a lot more to your day-to-day finances. This next one is probably the most practical change of the year. Previously, if you wanted to claim work-related expenses without keeping detailed receipts, the limit was just $300. From the 2026 to 27 financial year onward, that limit has jumped to $1,000. In practice, this means when you lodge your 2026 to 27 tax return, you can deduct a straight $1,000 from your taxable income with no receipts required at all, if you choose to. And if your actual work-related expenses come to more than $1,000, you can still claim the old way with detailed records, whichever gives you the bigger benefit. This change is expected to help around 6.2 million workers, which is roughly 42% of all taxpayers, with an average saving of about $205 per person. It also makes lodging a return far simpler, since millions of people will no longer feel like they need to keep a shoebox full of receipts. One important detail: this doesn't apply to the 2025 to 26 return you're lodging right now, up until October 2026. It only kicks in for the 2026 to 27 financial year, meaning your next tax return, filed in 2027. There's good news for small business owners too. The $20,000 instant asset write-off, which lets businesses deduct the full cost of equipment in the same year it's purchased, has now been made permanent. It used to get renewed in the budget every single year, leaving business owners waiting each time to see whether it would continue. Now it's a fixed rule, which makes planning far easier. You can buy equipment with confidence, knowing the deduction will be there, no matter what next year's budget looks like. Now for the change that probably has the biggest day-to-day impact on employees: Payday Super. Previously, employers only had to pay Super quarterly, meaning your Super landed in your account just 4 times a year. From the 1st of July 2026, employers now have to pay your Super contribution on the same day as your wages. That means your money starts working and compounding sooner. And if an employer is ever late paying Super, the ATO can now monitor this far more closely using payroll data. One small transition point: some employers had until the 28th of July 2026 to pay their June quarter Super under the old rules, so you might see both systems overlapping this month. But going forward, Super arriving with every payday becomes the new normal. If you're thinking about putting extra money into Super, the contribution caps have gone up, and it's worth knowing the new numbers. The concessional contributions cap, pre-tax contributions like employer Super and salary sacrifice, has risen from $30,000 to $32,500. The non-concessional cap, for after-tax contributions, has gone from $120,000 to $130,000. And the general transfer balance cap, which determines how much you can move into a tax-free retirement income stream, has increased from $2 million to $2.1 million. These changes are especially useful if you're nearing retirement and looking to maximize your Super contributions in these final working years. There's also an update to something we touched on in an earlier video: the Medicare Levy Surcharge threshold. It's now risen to $105,000 for singles
and $210,000 for families. That means if you don't hold private hospital cover and you earn under this new threshold, you won't be hit with that extra surcharge. These thresholds get indexed and rise a little most years, so it's worth keeping the current number in mind. Here's a change that won't touch most people directly, but it's still worth knowing about. Division 296 tax. If your total super balance is above $3 million, the earnings on the portion above that threshold will now attract an extra 15% tax. And if your balance is above $10 million, there's a further 10% on top of that for the portion beyond it.
This won't affect the vast majority of Australians, but if you're a high-balance super holder or a business owner with a large self-managed super fund, it's definitely worth a conversation with your advisor. A few more changes kicked in on the same date. Paid parental leave has increased from 24 weeks to 26 weeks, giving new parents extra time at home. The national minimum wage has risen by 4.75%, now sitting at $26.44 an hour, benefiting roughly 3 million minimum and award wage workers. And if you work in accounting or financial services, there's a new compliance requirement too. Client identification and verification rules have become a bit stricter. So what does all of this actually mean for you? If you're an employee, check your next payslip and confirm your super is landing with every payday. When it's time to lodge your 2026 to 27 return, weigh up whether the $1,000 instant deduction or claiming your actual expenses works out better for you. And if you're nearing retirement or running a business, it's worth planning around the new super caps and the now permanent instant asset write-off. That's the full rundown of what changed on the 1st of July 2026. Some of it's small, some of it genuinely significant, but together it shifts your financial picture for the year ahead. If this video helped, hit like, subscribe, and let me know in the comments which of these changes affects you the most. See you in the next one. Take care.